Quantitative investing is a data-driven approach. So instead of relying on things like your discretionary judgment and subjective analysis, what we do is we distill our investment concepts into models and algorithms, which are then subsequently heavily tested and validated to make objective and repeatable investment decisions, such as like what to buy or sell, how much to buy or sell, and when to buy or sell. So unlike your traditional way of investing, which depends heavily on the individual and can be influenced by things like their emotions or random events that happen outside the market, quant investing, on the contrary, follows a very systematic process that is designed for efficiency and consistency. Now, there are many advantages. Like for one, it removes the emotional biases and ensure that the same tried and tested consideration and rules that you have developed and tested are applied every single time in the market. So that allows for consistency and repeatable long-term performance. Then second, you can easily process very large amounts of information with quantitative approaches. So this allows the quantitative strategies you're running to be scaled easily, whether it is internally within the same market or across different markets and different asset classes. And third, it allows you to rigorously test your investment concepts or thesis before implementation to see if they work, and if they work, how well do they work. It can help answer very important questions like what are the strengths and weaknesses of the strategy, what is expected long-term returns, what kind of losses can I run into, as well as it gives you a look into how well this particular strategy fit into my overall portfolio. Now, some people associate quant investing with black boxes, high-frequency trading, or extremely high-risk type of strategies that are particularly susceptible to blowing up, like what happened to the famous long-term capital management or the LTCM. Now, on the contrary, most quantitative strategies are actually far from black boxes. So they're actually, in fact, very transparent, and they're very often based on sound financial concepts, which are then extensively modeled, tested, and statistically validated. Alright, and there can also be many different types of quantitative strategies. They don't necessarily have to be high-frequency trading type of algorithms. Okay, they can also be based on strategies that have a much longer-term horizon. For example, your value strategy, momentum strategy, as an example. Then finally, the issue of funds blowing up, which you read around in the news, is almost always a risk management issue. And that can happen to any type of investments or any strategies. It doesn't necessarily have to be a quantitatively driven one. Now, the day-to-day operations and the investment decision-making process can be fully automated with minimal human involvement. But everything that you see that runs behind a model, whether you're talking about a concept, whether you're talking about the logic or the design, everything comes from human expertise. So humans are the ones that conceive the strategy. They're the ones that design the models. They're the ones that program the logic. They're the ones that validate the data. And even when you're actually running live operations, humans are still crucial for oversight functions like monitoring the executions, handling exceptions that can happen every once in a while, as well as reviewing the performance of the models itself. So all these are critical to the success or the long-term success of the quantitative strategy. So humans are always in the process itself. Well, that's a good question, but actually you can also ask this question to a non-quant investor, because how does he know that his investment thesis work? And very likely from a non-quant, you're probably going to get qualitative answers or references to academic studies that kind of support his rationale. In this respect, quants actually have a much more direct and scientific way to answer the question, because we are able to define the exact rules and logic of our strategies, which we can then test it rigorously with historical data to see if it works. And this process is called backtesting, and it forms the cornerstone of all quantitative investing strategies. So it's a very important process that allows you critical insights into your strategies, such as the strengths and the weaknesses, how much you can expect to make with this strategy over the long term? What is the kind of risk loss that they can possibly experience, and how well does it fit into the overall portfolio, etc., etc. So they can ask a lot of questions about it, right, in the quant approach. There is no such thing, right, as a holy grail strategy that can kind of like work across all kinds of different market conditions. But what you can have is the right strategy at the right time. For example, some models and strategy may work well in a trending market environment. Then there may be some others that do well in a range-bound kind of market conditions. Then there may also be some more unique ones that kind of thrive and do very well in turbulent or volatile market conditions itself. So the key to creating or constructing a robust portfolio, right, is not to find a holy grail strategy, but to kind of use multiple different strategies together to complement one another. So in a way, it's like teamwork. When you work alone or when you only have a single strategy running, you're going to have your own weaknesses. But when you come together and work as a team, you're going to be a lot more resilient and robust than a single strategy itself.